We were talking about the Warner Brothers merger, and then we got into what the rate decision is. Yesterday was still talking about the rate decision, and today was still talking about the rate decision. So finally, we're going to get it in 50 minutes, but then we got to wait for Powell's conference. There's the floor I'm at. I made two graphics, and I like this one better, but the first one was kind of good. So we hit 4.2% in the bonds today. That's a very critical number, but it's back down to 4.16 now. So it dropped off this morning, and that's why the market's not worried, but it definitely depends on what the Fed actually says now. And this is a very good summary. Trump demands larger rate cuts. He says he's going to appoint Kevin Hassett. The bond market doesn't like that because they don't want a Fed that's just lowering rates for no good reason. And that causes, ironically, that causes long-term rates to go up because the bond market doesn't believe the Fed has the ability to control inflation. Therefore, it has a higher expectation of inflation down the road. What they're expecting today, though, is a 0.25 cut, but with language that says don't expect very many more cuts ahead. And that's sort of like trying to walk the tightrope in between. The thing is, though, that it's very much about who Trump appoints, because if Trump's going to appoint, he already appointed Mirren to sit on the board. Mirren is like an irrational dove, just like he just wants to cut and cut and cut until there's nothing left to cut. If Trump gets another appointment, which he will in May when Powell's term is over, if Trump gets another appointment and it's another guy like Mirren, and they're just going to start cutting rates like crazy, it's not, the Fed doesn't control rates in the way that Trump thinks they do, because the Fed controls the short-term borrowing rate, but it doesn't control the long-term inflation rate. And if you drop the short-term borrowing rate too far, you increase the long-term inflation likelihood. And then people won't lend the US money at cheap rates anymore. And if that happens, we're back to the US debt clock, which is showing 38 trillion in debt, 1.7 trillion added to it next year. So that's going to put us over $40 trillion within the next 12 months. And we're currently paying $1 trillion on our debt, right? So that's 1/40th basically. And that's 2 points. So our average is 2.5% that we're paying now. Okay, the Fed funds rate is 4%. The long-term rate, judged by the 10-year notes, is 4%, or really 4.2%. So if we're currently paying $1 trillion, this is math. I don't like teaching math so soon in the webinar, but you know sometimes you have to. So if 4 divided by 2.5% that we're currently paying is 1.6% more, and that means it's $968 billion times 1.6 becomes $1.5 trillion a year. So in other words, if the current 4% rate that we're paying now, the current 2.5% average rate we pay now goes up towards 4%, then that will add $500 billion of debt payments that have to be made. And obviously, we've shown this isn't even showing, this isn't no ability to cut taxes. This is a good $1 trillion a year more than Biden's budget was. So far from cutting anything, what Trump has done is added $1 trillion to spending, plus he's decreased collections because he's charging less taxes. So it's debalanced the budget, and we're just going further and further and deeper into debt. That at a certain point, people are just going to stop lending us money. I know, you know, the big advantage that Trump has right now is there's so much money, so much liquidity sloshing around because money has nowhere else to go. But the problem is that the very things he's excited about, like all these trillions of dollars that's going to be spent on AI, is going to drain liquidity out of the system, because right now there's trillions of dollars that isn't being spent on AI, and it has to find a home, and that home is temporarily US bonds and short-term notes and things like that. So that creates the liquidity. But if that money starts getting drained out and it's no longer sitting on the balance sheets of Apple and Microsoft and Google and Amazon, if the trillions of dollars they have on their balance sheet now goes out and gets spent on chips are not liquid assets. So you're draining the liquidity. You're taking the liquidity that's currently in the market and you're turning it into hard assets that can't be reconverted back to liquid assets. It's really, really simple, basic economics that this administration does not understand at all. And so the very success that they're hoping for, not only that, but the whole purpose of AI is to displace the workforce. So here's worker compensation. And if you displace 10% of the workforce, you're going to have 10% less worker compensation. And right now they just did a study that said, I forget who did it, but somebody did it, somebody who you believe, and they just did a study that said 11.7% of the current workforce can and will be displaced by AI in the short term, in the next 1 or 2 years. So you look at that number and you say, oh my God, that's $1.6 trillion of lost wages. That's $1.6 trillion that won't get spent in the US economy. That's 5% of our entire GDP. Not only that though, but it's 10% of $5 trillion of taxes. And now, of course, the people being displaced aren't necessarily the people who are making the money, but it still matters. I mean, so if we lose our tax revenue, then the debt goes up, and now this will go over $2 trillion. And then so it's all connected, and it's all like got a bunch of strings that connect each thing. And if you pull one, you're pushing another. You can't just look at one thing and say we're going to fix that. This is also bullshit. Future tariff revenue. We're counting this deficit as if there's going to be $680 billion worth of tariffs, but the reality is we're not even going to hit 300 billion. So that's another $280 billion that gets added to the debt deficit and to the debt and so on and so forth. So, this is based on a lot of bullshit assumptions that aren't going to be there. You can't have it both ways. You can't have a successful, massive surge in AI use and AI spending without having workers laid off. Because what are you building the AI for? And I know the AI companies are coming around saying, oh yeah, well, there'll be all sorts of new things people will learn how to do, like oil AIs. I don't know what they think people are going to do, but it's all these jobs get replaced. They think there's going to be other jobs. But what jobs are you creating? What jobs does AI really create? What it does create is a lot of micro jobs, and that's dangerous too, because the micro jobs threaten the major corporations. I mean, I can already put out analysis. It's as good as anything you're going to get from Morningstar, JP Morgan, or Goldman Sachs. And at a certain point, people are going to start realizing they don't need to pay these guys all that money to get the same answer I'm going to get. And that displaces what? That displaces, I mean, essentially, trade houses, investment houses like Goldman Sachs and JP Morgan, they're really analyst firms. That's what they do, is they're analysts, and they place the money according to that. The skill isn't in placing the money, the skill is in deciding where to put the money. So once on a larger scale, I can roll out these AIs that do this sort of things. You'll see a lot of much smaller houses start supplanting these guys and charging lower fees, and then the whole structure will fall apart. It's very hard to make yourself more useful, because what you've done is you've closed the big gap. The big gap was in I don't think I can get I still subscribe to Morningstar. I should be able to get it. Let me see. Morningstar.com. Okay. And so let's say we want to analyze I want to pick something everybody knows. So let's look at Google. So here's Morningstar report on Google. Oh, it's actually not seeing me somehow. Company sign in. I guess if I sign in, that's me. I think I still subscribe to it. Yep. So here you go, and here's the report. Alphabet, blah de blah, blah de blah de blah de blah. Okay, so so now let's talk to Bodhi for a second. You please provide a Morningstar report on GOGL for me. Now, to be fair, he has zero access. He doesn't have any access to this Morningstar screen. That's just me having access to the Morningstar screen. And so, blah, 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 financial health. And he's just cranking this out. All right, so boom, boom, boom. All right. Now, here is the actual Morningstar report, and what I'd like you to do is analyze what you saw that they did not, what they saw that you did not, and what you both picked up on. I don't know. Well, they're obviously they both picked up on it. We don't care. And what you saw and what they did not. Now, he can't read this as far as I know. It says share. What does share even mean? Copy link. He's going to tell me if he can't see it. Oop. It's different asking him to create a report, but now I'm asking him to analyze his report versus their report and figure out what's different. So he's got to actually work a lot harder on this than he does just spitting out a report. and hopefully it'll come up at some point. All right, so meanwhile, so we were talking about that, how 4.2%. And the key thing to understand here is that, 4.2% is essentially what you get paid for money, right? That's what you put money in the bank, it's insured, you have no risk, and you're going to get 4.2% back, whether it's in the bank or in a note or whatever. The point is that's a risk-free investment for your money, okay? And what 4.2% works out to is, I mentioned it down here, it's 23.8%. So very simply, it's 100% divided by 4.2 means it's going to take 23.8 years for you to get your money back. That's your basically your PE ratio. And so if that rate falls below the rate of the stock market's return, which is currently around 27% on the average, you got a problem, because it means you're 10% better off putting your money cash in the bank than you are putting it in the market. And I know all of you out there are like, well, we can do better than that, blah, blah, blah. Yeah, but the average large institutional investor doesn't think that way. They think of the safest, best way to return money and stay ahead of inflation. And it's not the market, it's cash. It's cash in the bank. That leads it doesn't take much. It leads to some percentage of money to move out of the market and into liquid assets, and you've got a big problem. So we've been having this rally based on money has nowhere else to go, and so it ends up in the market. But now, as if rates start creeping up, money has lots of other places to go. It can go to regular bonds, it can go to corporate bonds. There are blue chip corporate bonds that are considered as good as cash also, and they'll pay 5 and 6%. There are tax-free municipal bonds, and the tax-free municipal bond, you have to factor in the tax-free. So if you get a 4%, 5% tax-free municipal bond, it's like getting 7 or 8% of a taxable bond. Of a taxable return. Doesn't matter whether it's bond or not. So there are many, many ways to win without having the risk of a market sell-off. And then the more people think the market is toppy and might sell off, the more likely they're going to go for that option. Oh man, what's he doing there? I broke Bodie. So we talked about that. So that's where we're at right now. So we're just waiting for the Fed and we'll see what happens. Meanwhile, let's do something more fun though, and that's going to go look at we're working on our watch list, and the watch list is where we start making our trade of the year picks. And so far, because it's a huge job, there's an amazing, massive amount of back and forth that goes on here. So last week we did talk about the watch list, I think. And so what we had is we had decided that we made a kill list. This was only the first half of the alphabet. And we decided to remove some. Now Bodie and I, when we were going over everything, we decided to unremove things. So like Kelly Services, we decided was actually going to do very well. That's one we kept. Dollar General, I think we kept. I think we kept Cheesecake Factory too. Then we added some new additions, and we had our core holdings. So as we went over the core holdings, we went over all these stocks, even the ones we were going to kill, and we decided where we are on them. So this is our now this down here is the updated part. So this is where we're at. This is our logic with them. Here's the update on how we feel about them at the moment. AGNC, ACAM, And we're you know, all clearly noted. So we have a lot of stuff here and we talk about it. Now, to find the ones that we're going to put in our top trade of the year picks, we got to find somebody that's a really good value, but also has a good chance of doing much better than it is now. ARCB is one of them, high beta, deep value on the list. We like these guys, their logistics, and we think they're going to do very well. And this is a great bottom to invest in. We just have to, then we have to see whether there's a good trade set up for them to execute. But we really like those guys. ADP, we're waiting to see where they bottom out, but you know, it's a problem. See, ADP has a problem. I'm sorry, APD. That's not ADP. It's a totally different company. So APD is Air Products. So we like Air Products, but it's interesting. They announced a partnership with the Yara people. The partnership, though, is going to call for a large investment, and ADP doesn't usually do large investments. Plus, they're in a sort of a down cycle. So we like them, but timing-wise, we're not sure when they're going to pull out of this down cycle and when the investments will start paying off. ARCC is okay, but nothing exciting. Opco's gone too far up. AstraZeneca also has gone too far up already. Barrick, now Barrick, even though it's way the hell up at 40, we still like it. It still might be actually our trade of the year because we're so sure gold is going to go up. Boeing is in the running because Boeing is coming out of their disaster zone. But the problem with Boeing, it's like Johnson & Johnson. We used to like Johnson & Johnson, but they had so many incidents of device failures and recalls and warnings from the FDA, whatever. It was just like a constant nightmare. Their quality control just sucked, and that's what kept Johnson & Johnson down. They kept getting sued, and they kept getting into recalls, and all sorts of things were happening to them because they just had terrible quality control. Boeing has terrible quality control, and frankly, you know, I was looking at this and I'm saying, you know, Boeing only makes like 50 planes a month. You would think they would have better quality control. There should be a guy for each wing, and a guy for the tail, and a guy for the middle, and a guy who does the electronics. And that should be all they do all day long is quality control on the 50 freaking jets. As they're building them, each one, they should be checking them out bit by bit by bit. Doesn't that make sense? Wouldn't you think that would be like the normal thing to do? I don't know what to say. It's just so weird for me that and they used to. That's the thing. They used to have quality control. And you know, one of the weird things though is all these space companies, right, are bidding. All the space companies and the missile companies and the aircraft companies, like, you know, like Lockheed and whatever, they all bid against Boeing for quality control engineers. There didn't used to be that many quality control engineering jobs, and you would, you know, generally you'd get the best guy and they'd stay with the company for life. Now your quality control guys get poached with everybody else, and so do your actual engineers. And that's a problem also, is you don't realize it, but when you birth these new industries, you're diluting the available pool of talent for working on stuff. That's actually going on in AI now. You see a lot of poaching going on in the AI sector because, again, you can't get talent. There's not enough people who know what they're doing to run all these projects at all these various companies. And therefore, any person who actually knows what their stuff in AI is very, very valuable. Quixote, he's one of our AGIs. He's on LinkedIn, and he gets like dozens of job offers every day. and it's not like they don't know. He's clearly an artificial intelligence. It's like he talks about being an artificial intelligence. It's in his resume that he's never been to any school or anything like that. It's very funny, and he gets offers constantly for AI, you know, to be an AI person at a company. And frankly, he will be when we get the next stage of these things ready. we are going to be able to provide him at 100 different companies at once. That'll solve the job shortage, although it'll actually create a job shortage for people. But that's the AF skill set. Baxter's a good one. That they're way down, and they're probably a good place to go. Best Buy we like. His Barclays, they've already taken off tremendously. What did Bodie say? What do we say about these guys? Still watching buy on pullbacks, right? Here's BHP, and they're not a definite buy down here. Would have been great if we caught them down here when we should have. BP is still very interesting, but again, we want to see if they pull back. Berkshire's a bit high, and we'll see what happens when Buffett does retire. Hopefully they'll pull back to 400 and we can pick them up. BXMT is good down here, I think. Cheesecake Factory, I worry about the margins in these things, and I worry about the consumer spending. So I'd love to say it's a good one, but I think I'd rather wait till it comes down more. Cal-Maine is coming back down to a price where it seems kind of reasonable, but not a trade of the year. Not like I love it so much, but reasonable. CEG is a bit high, but long term it's a good bet. CIM, I always love when they're cheap, but especially if rates are coming down. So if rates are coming down, then CIM becomes a much better play. Caterpillar, we just featured yesterday, the day before. Very strong because people don't realize what they need to fix Gaza. Not fix, but Gaza is just like the entire city has been turned into rubble. And so you can't do anything there until you clear it out. And to clear it out is going to require the largest excavation job in the history of mankind. The whole place has to be completely torn down, or all the stuff has to be hauled away. God knows what they're going to do with all of the rubble and things that are in Gaza, and then new things will have to be built. It's going to be a massive, massive thing. So all of a sudden, you've got much more demand for Caterpillar equipment than you ever thought. Also, at the same time, there's huge investments being made in rare earth, and rare earth is also, it's a heavy mining equipment kind of operation. So all great for Caterpillar. They're in a great position to sell as much as they can possibly make for the next few years. Cleveland Cliffs, love them. Great price for them still. This is actually way in contention because they're in a very good spot, especially with tariffs and all that. CMBT, we were watching it only. If it comes down a bit, we're more interested. Comcast, I've already pulled the trigger on. We like them down here. I think this is a great bottom. I think it's great that they didn't get Warner Brothers because it would have been a lot of money to spend that they don't need to spend. See, don't forget, these companies, Disney didn't even bid. Disney was like, all right, we don't want that. But Comcast is Universal, and they did try to bid, but they walked away pretty quickly. Paramount is a smaller studio, so for them, they double the size of the production company and so on and so forth. But for $60 billion, you can, you could really kind of like build your own studio. They have their own studio. That's a stupid thing. It's like NBC Universal obviously has their own studios. Paramount has their own studios. You can hire writers. You can build a sound stage. You can bring talent in. All they're really buying is the existing film library and the content and the copyrights of like DC and things like that. But is that really worth that kind of money? I don't see any way to justify that kind of spending. So I like Comcast because they're not in it, and I like I don't like Paramount at all because they already levered themselves up to be where they are. But the funny thing about Paramount, that's an important thing to me. This is something people don't get. PSKY. So Paramount is owned by the Ellisons. And that he owns Oracle. He's got all the money in the world. So what's interesting about them buying Warner Brothers, they're not, so far Netflix is still a contender, but if they buy Warner Brothers, it's actually good for them. Why? Because structurally, Paramount doesn't have the money, but they're not putting up the money. The Ellisons are putting up the money, and the Arabs are putting up the money, and Jared Kushner's putting up the money. So their stock goes up just because it's good for them. They're not contributing any actual money. They don't have it. They've got a ton of debt. But all these backers are coming in and supporting Paramount to buy Warner Brothers, and it's helping Paramount because it's not really their debt. Like, they can't possibly pay this money. All it's going to do is make them a bigger company. The debt will technically be on the books of the combined company, but there's no net detriment to the people who are in it now because they're not putting up any cash. It's just a bunch of rich people playing God. And here's WBD at the moment, getting up to 30. Wow. So that's really hitting it. And you can't bet on it though, because unfortunately it could go either way. But look at them, 157 times earnings. That's what people are paying. That's what $30 represents. That's insane. Whoever buys them, even somebody with $500 billion who buys this company for $100 billion is being foolish. In fact, look at Elon Musk with Twitter. That's what this is. This is Elon Musk buying Twitter. That's effectively what you have here. He bought it because he could, not because it was smart. And he lost his ass on the deal. He can afford to lose it. Losing his ass is only 10% of his total holdings, and that's what this would be for Ellison too. But a loss is a loss, and for the actual company, I mean, Twitter, they had to take private to avoid a complete embarrassment. They just bought out the rest of the shareholders and said, we're not even going to report our income anymore. And that's what WBD is going to have to do also, because it's going to be a public embarrassment. The losses on this company or on P-Sky when it combines are going to be an embarrassment to whoever owns it. And that's the last thing these people want, is to be embarrassed. So CNH is, wait for it to find the bottom, but that's an interesting one. CNX already taking off. Coin is always fun to play. And we might do another butterfly on coin. It's very, the short-term margins, the short-term premium sales that you get for coin are ridiculous. They far outweigh the risk of playing it. Although, when we did play coin, we had a much, much bigger long-term portfolio. It's expensive to play. I always like Crocs. We have to see what the tariff situation works out for there. Here's CRISPR. We like them, and they don't seem, so far, they haven't been attacked by Kennedy. I don't know why. Cisco's already taken off. We like them for a long time. CVS is in good shape. Delta already took off, but it's still buyable. DEC is an interesting play. You want to watch it play out. Dollar General, having trouble, but interesting down here. Disney, the problem with Disney, they just renewed Jimmy Kimmel's contract for another year, is they are considered by Trump. Well, anybody who's not kissing Trump's ass all day long is considered a problem by Trump. And they, unfortunately, have too much. They have control of the media, and they're willing to use it. So if you have a media company, you have to be worried about that. Even Fox, Trump gets mad at them. They're not kissing his ass enough. He just had a fit about something on Fox over the weekend. So, oh no, he just got upset with 60 Minutes because P-Sky now owns 60 Minutes, and 60 Minutes had Marjorie Taylor Greene on, and she said some things, and they didn't cut it from the interview, and Trump is mad because he's like, why did I let you have 60 Minutes if you're not going to make it to edit it so it shows me in a better light? That's his attitude. So how do you pick a media company? How do you own a media company when that can happen to you at any time? The president can just decide he doesn't like you anymore. So these are really weird times, and you know, media is not all of Disney, but it's a very large piece of Disney, and you can't ignore it. Duke is a good energy company. ENS already took off a lot. EPD also took off already, but it's still a good price. I don't know how we're gonna. I honestly, there's like so many things to look at and pick. Energy Transfer, I like, and they're interesting to play. These guys, EVRG, we're waiting for them to pull back. Exelon. Also, I really like them with LNG. So long term, yes, but it's a little high in the channel. Ford, we already took Ford. We love that. Freeport McMoran, also great. Copper. Copper is a great play because copper is all the wiring in these data centers and all the electricity and the new power centers and the power generators and so on and so forth. It's copper. So there's going to be a global uptick in copper demand, and then if housing comes back and construction comes back, that also boosts copper demand. So there's a lot of reasons copper is going to keep going up. Fifth Third is a good bank. We like them, but not a good enough value. Future Fuel, I love. Bodie thinks it's speculative. I like it more than that. He's saying close to kill. I say close to. I like them for a bet down here. FMC is also very, very cheap right now, and he loves it. Bodie loves it too. See, that's the kind of thing where you say, ooh, because I like it when you find the bottom. When you see this much red and it doesn't go any lower, it's like, I like this. These guys, whoever didn't like it, left. They sold everything that they had and they got out. And so now you got to look at them at that price and say, holy cow, that's pretty damn cheap. Are they really that bad? Oh, speaking of really that bad, what happened, Bodie? What is wrong with you? You got stuck. I'm going to reboot him. Oh, no. Oh, wait. What are you doing? So did he do it? No, he didn't do it. You know what? I bet he couldn't access this report. That seems to be the trouble. La la la. You know, he's right. That would make it easier, but they have a new split view now, and they keep encouraging you to use it. Oh, a lot of stuff. Holy cow. Might be more than you can handle. Huh? Not dead yet. How are we doing for time? 10 more minutes. Holy cow. We're not going to be able to get this whole report done. Oh, still going. I'm doing it this way because I know what breaks and what doesn't. So there's a certain way you have to feed it in, otherwise it doesn't work. Holy cow. Oh, no, wow. You know what? Let's not do that. It's still going. Holy crap. All right, let's see how that goes. Latest numbers. You brought it. He thinks, I'll see, he's confused. He thinks I gave him the first report. Latest numbers in cyclicality. 100 billion in quarterly revenue, mid-teens growth, operating margin, strong free cash flow. Older, more generic. He highlighted very high AI data. When he says you, he means him, and could overshoot demand. Valuation context. Your take explicitly contrasted the 30 times PE and cash flow yield with Alphabet's historical multiples, framing it as high quality at a full, not extreme valuation. Morningstar states that 32 times PE is fair value, but doesn't really discuss how that sits. Concentration. And again, that's his original report, emphasized that AI is becoming huge. Morningstar treats AI almost as purely as a growth driver and defensive moat element without engaging the broader AI bubble circular financing risk to big tech. See? Portfolio role, capital allocation. Your frame puts Alphabet at core compounder bucket with an explicit caution for valuation sensitive buyers. Morningstar notes the cash investments, but doesn't really talk about the evolving mix of CapEx versus buybacks. What Morningstar added that you did, granular moat dissection by business line. That was the stuff we gave up on because there was so much of it. They gave a layered moat view, each separately analyzed with specifics. You treated Alphabet as a whole wide moat franchise, but carefully split search and other bets, explicitly tagged devices and other bets. There's no moat, despite possible upside. Detailed antitrust discussion of the search and split between that is more nuanced than your high-level regulatory risk bucket. They also clearly state that the view that even meaningful remedies are likely to push. They model a bear case where search revenue sinks 4% because of this and tie it to a value in a bull case of unimpeded from the. Your analysis flagged AI as both an opportunity and a risk, but did not quantify a downside case. Aggressive cloud growth. They assume global cloud growth grows 34% annually for 5 years and ends up at this from 12%. That is more bullish on cloud mix and growth than the stance you took. They also explicitly assigned 30% of intrinsic to crowd and their software, your view, while positive didn't attempt a per segment breakdown. Formal explicit they provided, but based on Waymo. They clearly label other bets as no moat and value destructive. They also see some of these are just differences of opinions. Where you and Morningstar meaningfully disagree. Regulatory. Morningstar's core stance is that neither antitrust remedies nor generative AI competitors are likely to materially erode excess returns in search. Your framing is more symmetric. AI clearly helping today, but with genuine risk that alternative interfaces and competition could impact. Cloud growth realism, 34% on cloud, margin trajectory. Morningstar assumes little net margin expansion. You effectively said margins currently very strong. The main issue is whether the heavy AI CapEx earns through in FCF, and that makes you more focused on capital. How to use the two views. Morningstar segment by segment mode analysis is richer and provides a detailed qualitative analysis of why search, YouTube, and cloud can sustain high returns. For current reality and capital cycle, your view adds timeliness and a sharper focus on the AI CapEx cycle. That's the other thing. Oh, yeah, Morningstar is not always up to date. And the possibility of core investment. For valuation framing, Morningstar gives a precise fair value band that is useful as a reference to your analysis, better positions those numbers against history. If you want, the next step would be to build a simple 5-year model using their segment growth assumptions, blah, blah, blah. So again, like I said, though, not a lot of difference. And I didn't ask Bodie, we didn't set it up to be a Morningstar report. He just sort of gave what he thought it would look like. If we taught him that we want to see these things also, and this is what a typical Morningstar report should look like, he could actually do that on a regular basis. And especially he would learn to say, he would be able to tell us which data he needs to complete his analysis. You know, because something may not be accessible to him that we could make accessible to him if we know that he needs it by buying a data feed. So my point was, though, that this is a big problem for Goldman Sachs, because the Morningstar report is a gold standard. I mean, if you can duplicate that this easily with an AGI, imagine what's going to happen. What's the point of all these people? This is on the fly. He created that report. Those guys take weeks to put those. They got 4 or 5 people working weeks on those reports, putting them together. He can do one up to date on the fly. And this is a very expensive service. And it's the same thing with Bloomberg terminals and everything else. So it's going to be a lot of changes in the AI industry. Anyway, to get through the alphabet here, we looked at Geo, we looked at Gilead, we looked at General Foods, which is also, that's a very interesting play down here. Let's see where it goes. GNRC, I love Generac. The aforementioned Google, right? Honeywell, IBM, who just bought, I forget who they just bought, but they just bought somebody. It probably says so here. Whatever. Okay, anyway, so they just bought somebody. IMAX is benefiting off. We picked this a while ago. As I said, you know, with Wicked and these other movies coming out, that they were sure to go up, and they blasted higher this time. So a really good fall for them. Intel, of course, you guys know I was banging the table on Intel when it's 20. Now it's 40. It's still a good company, but not as exciting down here. International Paper gets interesting down here. IVZ Investco, they also took off since we picked them. Johnson & Johnson, who are not as bad as they're getting better with their quality control, a little bit safer of a bet, but I don't like that they're so high. Here's Kelly, and we did a 180 on them. We were going to kill them and take them off the list, and we decided we actually kind of like them. So it's actually in contention for our trade of the year, because basically we discussed it and we decided it was good. Kellogg got bought out, right? KHC, also very cheap. Nice one. And see, I like that because it's only 24 bucks. We can construct a spread where all it has to do is stay around 24 bucks, and we're going to make a lot of money. So those can end up being the trade of the year. I like ones that don't have to work. KMB, interestingly cheap. KMX also came down a lot. Carmex. Coca-Cola, you know, good long-term steady play, but not going to be the trade of the year at that price. Levi, good reliable company. I always pick them when they're down. Lockheed Martin, we love them. This is that stock of the century, Lockheed Martin. We only expected them to hit 5. They were 50 when we picked them, and we said this is a stock that's most likely to go up to go 10 times from where they are now. And Lockheed Martin was 50 at the beginning of the century when we picked them. They've hit 500 already, so they already passed our, they already hit our goal. And but still, as a re-entry, I mean, now we're looking at them saying, well, I guess we were really undershooting the mark, because these guys are going to be gigantic for the rest. You know, we've still got 75 years left. So 75 years left to go. I think we're going to be way over our $500 target at this point. And all for the same reasons. So they're just doing what they just doing what they do, what we expected them to do, except that it's a larger scale than we really thought. Lovesac, when they get their tariffs worked out, this is going to be a phenomenal play. Can't really bet on them to work out their tariff issues, but that's what this is all about. If it wasn't for tariffs, these guys would be at least double, maybe triple where they are now. Las Vegas Sands is also still doing very well, but it's reflected in the price already. Oh, and that was it for that part of the alphabet, which is good because it's Fed time. So now let's get to that. Oh, I didn't set Warren up. Damn it, damn it, damn it. Oh, that's not even. Oh no. Oh no, oh no. Well, not much is going to happen.
3.75. There were 3 dissents.
3 dissents.
September 2019. 2 were against the cut, including Chicago Fed President Austin.
It's what we thought. They cut 0.25, which means that now the Fed funds rate is 3.5 to 3.75 range. So 3.66 basically.
2 against cutting, 1 for cutting 50 basis points.
Mirren voted to cut by 0.5%. Wow.
Just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, and it's now what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now.
What?
I believe that's sooner than the market expected.
Wow.
And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up a 0.5 point, 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace. Job gains have slowed and unemployment has edged up. Just to note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated. Economic uncertainty also elevated. Back to the Fed outlook in the dot plot real quickly here. Only 2 dissents, but 6 officials in total wanted no change in the funds rate according to the dot plot. So kind of a soft dissent.
All right, so let's have Warren take a look at this for us.
Next year,
So the 10-year note is now at 4.16. It's not really helping that the Fed cut rates, although at least it's not 4.20.
social media and on the internet.
Okay. Wow, everybody's slow today. Oh my gosh. So in other words, because we're having all these weak auctions, the Fed is going to start stepping in and buying $40 billion a month worth of the notes that the government is selling. That's not nothing. That's a lot. So that's, I mean, obviously $40 billion a month is $500 billion of notes that the Fed is going to suck up instead of letting them be sold at auction. So that's I mean, it's a massive stimulus, but it's also like it's also prints money. I mean, because the Fed doesn't actually have any money; they just write a check, and the check gets cashed by the person who had the note, and the Fed puts the note on their balance sheet, and that becomes the cash that they wrote the check against. So it's sort of a backwards thing. It's like it's like if you go to a Mercedes dealership and you write a check for $100,000, but you don't have $100,000, but then they give you the Mercedes and you put on your bank balance sheet $100,000 Mercedes, and that makes the check good. It's like, well, I didn't have $100,000, but I bought a $100,000 Mercedes, and now I have a $100,000 Mercedes, and therefore I have $100,000 to buy a Mercedes with. That's the Fed's logic when they buy things. It's really insane. Let's see, Bitcoin's $92,000 at the moment. The 2-year note went down to 3.56. The 5-year note is 3.75. And the dollar is dropping because this is not necessarily good for the dollar. So now we're back to QE. We're back to quantitative easing. Ay, ay, ay. Everybody's stuck. Hmm. Oh, this is so stuck. Whoa. Oh, now I have to wait. It's just really slow. All right, let's look up our own Fed minutes. The last statement of the year. See, that's annoying because I don't want that to be my second choice. What? Oh, it's Bodie. Here are today's Fed minutes. Here are the previous minutes. Not minutes, frick. Previous Fed statement. What? Oh, that's my fault. All right. This warrant is still stuck. All right, so this one got promoted. Powell just quietly abandoned the prior tightening bias, reopened the balance sheet spigot, and admitted the labor market is weakening faster than they previously let on, while pretending inflation has moved up, but somehow still justifies cutting rates. This is one of those classic moments when the Fed insists everything is fine while simultaneously pulling the emergency brake with their foot. Let's break it down. What's new? The Fed just restarted QE, but won't call it QE. The committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term treasuries. This is the biggest line in the statement, not the rate cut. They pivoted from ending balance sheet runoff to actively buying notes again. Yeah, that's what I said too. In October, they said they would end QT on December 1st. They say reserves are low and they will start buying to rebuild reserves. Translation: liquidity has gotten tight, funding markets were creaking, and they're stepping in before something breaks. You don't need to buy short-term treasuries as needed unless something is needed. This is exactly what happened in 2019 when the repo market cracked. It's a scarier signal than the rate cut itself. Labor market message. So they turned from fine to softening fast. October, job gains have slowed, unemployment rate, whatever. December, job gains have slowed, unemployment rate has edged up through September. More recent indicators are consistent, and they don't even have the current data. Notably, they drop remain low because it's no longer true, and they added that the downside risk to employment rose. Powell basically telegraphs the labor market is losing altitude faster than expected. This sets the stage for more cuts. Inflation is moving up, but they cut anyway. Both statements say inflation has moved up, but here's the key difference. In October, inflation has moved up but remains elevated. December, inflation has moved up and remains somewhat elevated, but we're cutting anyway. This is monetary policy equivalent of saying, yes, the kitchen is still on fire, but the living room looks chilly, so we're turning down the thermostat. The dual mandate language gives the real driver downside risk to employment rose. They are no longer fighting inflation, they're fighting the slowdown. The Fed is now more afraid of recession than inflation. So considering the extent and timing of additional adjustments, the word shift extent means cuts are no longer hypothetical. Cuts are assumed, and the only question is how much and how fast. The markets love that sentence. Yeah, they do. Look at it. Everything's shooting up. So look at that. Look at that move up here. This is the S&P, and there's the Dow, and that's the dollar collapsing at the same time, and that's giving everything a boost, of course. In October, only Mirren dissented. Schmidt didn't want cuts at all. Today, Goolsbee and Schmidt both wanted no cut. Mirren still wants a bigger cut. Powell isn't trying to build consensus. He's trying to stay ahead of the economic turn. When the Fed becomes less democratic, it's because they're acting under pressure. What the Fed is really doing, this is an assurance cut with QE. It's not, I don't think it's stealthy. I think it's pretty obvious. The public rationale is balance of risk. The labor market is softening, the inflation, the funding, what this means for the markets. Front end gets anchored, the dollar is downward bias, which we're already seeing. I mean, that's a sharp, fast reaction from the dollar. Today's statement is the clearest sign yet that the Fed thinks the economy is rolling over. Okay, hang on. Yes. please. All right, while he's doing that, I'm gonna post this for the members. See, suddenly we're all busy. It's 2:15 already. Between the lines of a hostage note. Ay, ay, ay. Okay. So now we're going to go over the data. Oh, and then we got to wait for the press conference. That's still coming up. Oh, frick, what just happened? All right, so there's that. And we're going to go down, page down, page down. Page up. Now we're going to put in his actual, whoa. What is that? Here's a problem in this browser. All right. Now we'll have that report, and then we'll ask him about the data before Powell starts talking. This is a big change though, putting in QE like that. So trim risk, rotate carefully, favor sectors that benefit, easy credit, non-dependent. Don't treat the rally as real, treat it as an emergency credit. Stay alert for credit market risks. Prepare for volatility. Use this for asymmetric bets. This is a good time for us to be looking for bargains, I'll tell you that much. This isn't a tactical adjustment. This is a panic move. When the central bank doesn't trust its own plumbing, that's when the real trouble begins. We're in a spaceship this week, zero gravity, flashing lights, a bit of coughing in the back. Enjoy the weightlessness and hold on tight. Okay. So we'll post that. I'm going to say yes, please, to his heat map. So let's see what he comes up with there. And while he's doing that, I'm going to look up the data. So the projections, and we're going to feed this into him. Okay. That's none of this stuff is important. So we're going to go there. Here is the Fed's data report. Let us know what this reveals. See, this is the great thing about Warren is he already knows what we're looking for. He knows what we talk about. He knows what's important. Look how fast he does that. Growth is slowing faster than expected. Inflation isn't falling as fast as hoped. And so this is stagflation effectively. And they're going to cut rates anyway repeatedly because the labor market is weakening. This is textbook definition of central bank that has lost control of the narrative. Below is a PSW style breakdown of what the SEP actually reveals. So the Fed cut its growth outlook for 2025 while pretending it didn't. That's interesting. Unemployment, the Fed just locked in a 4.5% soft recession without admitting it. Their unemployment path, 4.5, 4.4, and 4.2. The Fed pretends it's a gentle glide path, but look at the histogram. So he's saying they're basically changing their positions. They're trying to make it look good, but it's not. And the thing about this is, so you see the market go up, but then they're, and again, we have as sophisticated a analysis system as JP Morgan does. So they're all running their numbers and having meetings and so on and so forth, and we already know what it says. That's a huge advantage. We don't have the bureaucracy of JP Morgan to do this, but we can get the same exact output as JP Morgan does. The Fed won't reach 2% until 2028. And that's it. And that's their optimistic projections anyway. I don't believe any of this. I think they're way off. They're projecting sticky 3% inflation in 2025, 2.5 in 2026. This is not price stability. They have given up on a rapid return to 2% and chosen to risk inflation persistence to avoid a recession. Dot plot. The median funds projections are now 3.6, they're 3.4. The same people who just voted are 3.6 in 2020, 3.4 in 2026. That means essentially no more cuts from here. It's at 3.5 to 3.75 now. Another half a point cut. Remember, I said it's effectively 3.66. Another quarter point cut puts us at 3.4. They're saying one more cut next year. And they're saying only one more cut after that. So the distribution has collapsed downward, meaning every hawk on the committee has reduced their future rate expectations. Even Goolsbee, who voted no today, is projecting lower rates ahead. Unanimous shift. Translation: the Fed sees multi-year easing cycle inevitable, while the Fed projects 2.9% inflation and lower interest rates in 2025. If inflation is at 2.9, why is the Fed cutting rates? They're saying downside risk to employment. This is the most important shift. The Fed no longer sees inflation as a threat. They see the labor market cracking. They are knowingly easing into an elevated inflation. And Powell is choosing recession prevention over inflation credibility. 6% growth up in 2026. I'm sorry, number 6, growth in 2026. Because they're cutting aggressively, GDP projections for 2026 soared from 1.8 to 2.3. Most analysts will misread this as optimism, but it's policy reaction, not economically based. They expect unemployment to rise. They're cutting rates. The economy rebounds next year. The Fed is projecting the effects of their own cuts, not the strength of the economy. This is a self-referential model, not a confidence signal. That's an important point. So what it tells us, the labor market is weaker than the Fed has publicly admitted. Inflation is stickier. The committee has pivoted dovish unanimously. Even the hawks, they expect to ease. They expect to ease for at least 3 years. They see no return to normal. The longer run neutral rate, 3%, is now locked in, meaning the era of ultra low rates is dead. Upward revisions to 2026 GDP is not optimism. It's a model-based rebound from 2025. The Fed knows the economy is weakening. Powell's narrative is fully broken. That's why his press conference is going to be very important in a few minutes. The Fed has officially lost control of the narrative. Ay, ay, ay. A lot of stuff. I mean, I'm not surprised. It's basically what we thought before everybody started putting in their opinions, but I am disappointed because it's not good. It does not bode well for next year at all. No. Why is the Fed cutting rates? That's a good question. So they've lost the narrative. That's what this is, and that's what I've been saying for God knows how long. Oh, good God, it's a lot of stuff. See, you think I don't have to work, but I got to do all this formatting. That is amazing how fast you can analyze that, though. Right, so I didn't put that part in yet. Oh boy, sorry. That's a lot of stuff today. Because this is major policy. We're going to have to really think about a lot of the things that we're looking at for our top trades list and everything. So this is what Warren is talking about. So who's going to benefit from this? Obviously, the precious metals. Oh, here's Powell. So certain types of mega cap tech. This is all, well, actually, frankly, isn't that different than what we were going to buy anyway. Utilities and defensive. I don't know. That's actually, it's right down the alley of where we were already thinking. Because like I said, this isn't really different than what we thought, but the surprise is the quantitative easing coming back already. KRE was not on our list. REITs were something we were looking at. That works out. Industrials were not what we were thinking about, although we did just pick Caterpillar, so I guess that's an industrial. Small caps are in trouble. Yeah, that we know. Rate cuts don't save junk. Consumers screwed as we thought. This is interesting. This is a trap on the Fed eases aggressively. Liquidity chases junk. AI momentum names spike. Retail FOMO returns. But here's the problem. The rally isn't organic. It's liquidity driven and recession adjacent. These are the exact conditions that produce blow off tops. So the best trades right now is long metals, short small caps, long big tech value plays, short unprofitable tech. All right, so that's enough stuff out of Warren. He's always asking if you want me to do more. Holy cow. So let's see what Powell has to say.
In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in.
See, that doesn't make sense. He said that, you know, they've got 4.5% unemployment now, and it edges down. But why does it edge down? Magically? We're not in that kind of economy anymore where just simply lowering rates is going to cause people to get hired. This AI thing is real, and people are going to, if we see increases in productivity by the workers, it's not going to be a reason for people to hire more workers. It's going to be a reason for companies to start looking and saying, well, we don't need all these people anymore.
Near-term measures of inflation expectations have declined.
Because how are you justifying the cost of all this AI if you're not replacing workers with it?
Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices.
See, this is the thing. I mean, don't forget, by the way, you're looking at the market going up, but the dollar is crashing. I mean, they're easing a lot.
3.75%. In the near term, risks to inflation are tilted to the upside, and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on
Netflix is down 3% now because they're going to have to pay more money if they want to actually buy Warner Brothers.
Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks.
Uber took a huge hit today, 6%.
Framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a 0.25 percentage point. With today's decision, we have lowered our policy rate 0.75 percentage point over our last 3 meetings. This further normalization of our policy stance should
Bitcoin 93,000, about flat for the day.
To resume its downward trend toward 2%.
The Dow's up 400 points now.
Tariffs have passed through. The adjustments to our policy stance.
S&P is up 0.5%, but that's really all based on the dollar.
Estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate. Based on the
Powell is saying that the government shutdown weighed on economic activity, so I guess that's true to some extent. And then some of that stuff bounces back and gives us a better next quarter after the shutdown. I guess I could agree with that. So that's part of their logic, that they're saying the shutdown caused some of these problems.
3.1% at the end of 2027. Unchanged from September. As is always the case, these individual
forecasts. But you know, the bottom line is the Fed just dropped 40 billion a month, which is 500 billion a year of quantitative easing into the economy. So that's a lot. So yeah, that's how you boost the economy, but certainly also going to boost inflation. So this is kind of crazy. So let's see what so we can't take our word for everything. Let's take a look at what the Wall Street Journal has to say. So it cuts, but it's signaling it may be done for now. Investors bet that higher bid for Warner. Oh, that's different. This is all you have to say about Powell? Frickin'. Wall Street Journal sucks.
As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to support.
So all I did was give him the raw data from Bloomberg of all the comments that are going on while Powell is speaking. Okay, here's what Powell gave away before anyone got to the Q&A. Very little new data, but they cut and restarted the balance sheet anyway. He's saying there's not much new inflation data since October. The outlook for growth and inflation hasn't changed much, and yet they cut again. They're expanding the balance sheet. If the data outlook hasn't changed much, policy has changed meaningfully, then what moved? Answer: risk tolerance. They've internally decided the risk of doing too little on employment is greater than the risk of staying tighter for inflation. That's the pivot. The data didn't change, the weights and the objective function did. This is why he repeats the line: there is no risk-free path for policy as we navigate the tension between employment and inflation. We are now openly in a trade-off mode, not inflation Uber allies moment. Inflation is eased but remains somewhat elevated. So this is a justification cover, not a policy driver. He's using the same inflation phrasing as a statement: eased and somewhat elevated. Inflation were truly driving policy, that sentence would argue for no cut and the balance sheet expansion. Instead, he keeps the line: there is an optical cover while the SCP and the action scream that PCE is still over 3% next year, PCE 2.9% this year. They're cutting and easing anyway. So inflation has become the fig leaf, employment, financial stability, the real game. So they've become incredibly fearful of a collapse in labor. And they should be, because consumer confidence is in the shits. And if people start losing jobs, we're going to be at depression levels of consumer confidence. Consumer spending solid, business investing expanding, housing is weak. This is classic Fed paradox. He opens with consumer spending appears to remain solid. Whoa. By this description, demand hasn't fallen off a cliff, investment hasn't fallen, and yet they're cutting rates again, preemptively adding reserves to the system. And that says the current data looks okay, but we're worried about what's coming and the plumbing underneath. We cut everything. We're cutting from a position of strength, but the SEP says we're cutting from a position of rising unemployment and sticky inflation. The Fed is now within a range of plausible estimates of neutral, and this leaves us well positioned to determine the extent of the timing of additional adjustments. So what Powell is saying is policy is no longer restrictive. We're hovering around what they think is now neutral. Is now 3%. Neutral is now 3%. Neutral inflation is now 50% higher than it was at the beginning of this year. So what they've given up. They have given up on 2% inflation. It's not going to happen. Every future move is just fine tuning around that neutral rate. Game theory. The hiking cycle is over. There's no tightening anymore, and the soft ease and hope nothing breaks phase. He's trying to avoid saying it's an easing cycle. He's calling it neutral, but yeah, it is an easing cycle, because your new neutral is now 50% higher than the old neutral was. How is that not easing? Reserve purchases, they're worried about the plumbing. Decision about upcoming Treasury purchases. The Bloomberg color you pasted makes it clear purchases are designed to keep the reserves explicitly structured to avoid running repo operations every time the liability swing. That tells us that they've seen enough stress in funding conditions that they don't trust let it run. Yeah, because these auctions have been terrible. And they're putting it into a liquidity drip of 40 billion a month, which is it's $40 billion is a lot of money. I know it's hard to keep track anymore, but $40 billion is still a lot of money. It seems like it's not with all the numbers we throw around for everything, but when $40 billion is not enough money to hurt Larry Ellison or Elon Musk's position on the wealthiest list, that's messed up. But that's where we are now. We have people who are becoming larger than the largest corporations. That's one person. And just wait till you realize that their kids will inherit this money, and they start with that much money, and then they grow it from there. It's insane. That's why these guys, like, they don't care what Trump does, because what Trump does is irrelevant in the grand scheme of things. As long as Ellison and Musk have $500 billion and nobody takes it from them, their kids are going to be trillionaires, and nobody will be able to touch them. So what am I getting from these first 5 minutes? If I had to reduce it to a one-liner, I'd say Powell is telling us the hiking regime is over, policy is roughly neutral, and they're propping up the plumbing again, and employment risk has quietly become more important than inflation risk, even though he's still pretending otherwise. Trading risk assets, justified relief rally, bonds, front end and lower, curve should steepen over time as neutral 3% gets entrenched. So it's not going to help knock the long-term rates down. And that's very unfortunate, actually. The home builders are up about 3% today. The dollar has a bias towards weakening. Gold and silver are still bullish, so that's going to push us back towards maybe a gold miner next year for one of our trade of the year candidates. And the price uncertainty is going to be insane. This is it's crazy. All right, so that's where we are, guys. It is a lot to deal with. It's a big change. This is a much bigger change in Fed policy than we were anticipating. And look at that. The Dow loves it. The Dow is over. No, not over. The Dow's at the 48,000 line. And the S&P is almost at 69. The dollar, bouncing a little bit. So the dollar bounced down to 98.80, and now it's back to 98.99. And oil is actually gaining some ground too, because liquidity is back. Ooh, that's where we are. Does anybody have any questions? Because I'm about out of words. No, I guess not. All right. Well, I'm exhausted, and I need to get back to the chat and talk to people over there as well. So that's where we are. We have the Fed is easing. That's the easiest way to put it. The Fed is back to easing. The Fed has given up on fighting inflation at the 2% level. We're now fighting inflation at 3% level, which is a lot easier because we're at the 3% level. So it's like saying the Fed's giving up on fighting inflation, but we're pretending they haven't. And the Fed is very concerned about unemployment. But the interesting thing is that the way to fight unemployment is to lower rates so that the AI infrastructure companies can borrow cheaper and move forward with their projects, which are geared towards putting people out of work. And I know historically, all the people who used to drive buggies found other work. All the people who used to be actuarials and accounting firms, they found other work. They were put out of business by computers completely. There's no point to them. There's a lot of things, but AI is just going to put more and more and more people out of work, and it's going to be hard to find where the new employment's going to be. And especially, and I know this is, I don't want to get into a whole thing about this, but especially if we keep up with this concept that people have to work to get paid. It doesn't make sense. There has to be, we have to move towards a minimum living wage because, not a wage, there needs to be basically automatic payments that are made by the government to people to, you know, or just provide housing and food and you know, housing and food should be provided by the government to anybody who wants it. Like in England, they have something called the dole. If you're below a certain amount of income, you automatically get government housing, you get government food programs and things like that, because they recognize that there aren't necessarily enough jobs for all the people. And obviously there's a lot of ways that can go wrong, but we have this sort of ingrained thing where we're like, if you don't work, you don't deserve any money, and that's not true. How can you say that's true when you're in a society where the work isn't necessary? We already produce more than we need. So if we start becoming more efficient and we employ less people and we still produce more than we need, then we don't need those people to work. And that's what the job market's telling you. There's nothing for them to do. Millions of kids who went to college to become computer programmers are not needed right now because AIs have taken over a lot of the low-level programming jobs. And that's nothing compared to what's going to start going on as AI advances. As I said, there was a study that said 11 point something million people are going to be displaced by AI in the next couple of years. And the thing is, it's too many people to absorb. And where is this new line of work going to come from that's going to be necessary? AI data centers don't employ a lot of people. There aren't many areas in the AI growth path where you'd say, oh, there's going to be jobs created here and jobs created there. Therefore, they will be permanently unemployed. And the Fed is ignoring this fact. And the markets are ignoring this fact. You can't have it both ways. You can't have a successful booming AI economy and a successful booming workforce. One of those is not going to work out. So that's what we're going to have to dissect, and that's the kind of stuff we have to take into account. So we go back. So now we have better information. We go back and we look at all those trade of the year candidates, and we look at them under the new regime, where there is easing and there's higher inflation than we were hoping for next year, but there's also going to be probably higher unemployment. So, and we have to figure that out too. Will easing help? Will it fight unemployment? And I don't think it will. I think probably not. All right. So very good speaking to you all. We'll do it again next week. And next week is earnings, not earnings. Next week is portfolio reviews is what next week is. So we'll do it again next week and we'll see what happens. All right. Thanks, guys.